Reality is, with current construction costs, land costs, and debt for new construction deals, you cannot get close to offering any rents close to a vintage product. So you have deals that, are to some degree insulated from the supply demand when it comes to the growth here
Yeah.
and the unit delivery.
Welcome back to Keeping It Real Estate. I'm Dan Breezy, and today we're excited to have a true expert in Texas real estate on the show. Joining us is Jakob Andersen. He's a key player on the Newmark Dallas team. Jakob brings over 13 years of experience and a broad wealth of knowledge with an extensive background in development, acquisitions, and asset management for a local $1 billion plus fund. Jakob is involved in every aspect of transactions, and we've worked with them on a couple deals. We're looking at deals with them. And Jakob, excited to have you on the show so we can talk about the state of the market.
Thank you so much, Dan, and pleasure to be on.
Yeah, so, diving right into it, what would you say the pulse of the multifamily market is right now? And this is being recorded here late, or I guess early November. I'm sure we'll get the show out mid-November or as soon as possible so it's accurate. But what's the transaction volume been like so far in Q4? And are there any specific trends that are starting to stand out to you?
Sure. Wanted to back up a little bit to put it into context with what we have seen in the following years. 21, 22 was remarkable years. We saw a record amount of closings. We saw record pricing. We saw just a lot of activity. Any and everything you put on the market, it would close one way or the other. Coming off that, this is slow. And that doesn't mean it's abnormal. I think 21, 22 was probably more abnormal. Going into 2023, things starting to slow down. We saw the interest rate starting to go up and down quite a bit in a short amount of time. And it made it very hard to plan, very hard to close deals. So we're starting to see these delays in these closings and deals that didn't make. So 23 was a slow year. What we started to see in the beginning of 24 is we could start to plan a little bit more. Things takes longer just because it's not the same price that's being paid. It's not the same cap rate that's being paid in a market with much higher interest rates. So there's a natural slowdown from 21 to 22, but it's still better than 23 because we can plan more for tomorrow.
Yeah, interesting. So with where we are in the market right now, it's slower. It's more difficult to get deals done. Values are still significantly down from, call it, the peak of late 21, early 22. So of the deals that are coming to market, what percentage would you say are of complete loss of capital versus, partial loss of capital or, some actual return on the money they invested from, a deal from 2021 or 2022?
Sure, it's a mix of all of them. We have recently closed a couple of deals where it was just above the loan balance, and there was a small return on the current equity. We have also just had a deal that was bought before COVID, where the return was very healthy to the current investors. So the true need-based sales, it is being sold for a reason, and to go in on a deal like that to double the current equity is a stretch. So we have seen the very low return, we've seen the hybrid in between, and we've seen a full return with a great profit.
Okay. Yeah. So talking a little bit about, cap rates, obviously, as we saw interest rates run up at the pace that they did, cap rates followed. Can you give us a sense of, where cap rates stand right now in Dallas on different asset
Yeah.
classes and what you might think we could see moving forward into 2025 with, the election's over, Trump is the president, and, the Fed has done a 50 basis cut. They got another one lined up. What do you see coming in 2025 with that and where cap rates are now?
Absolutely. So again, going back to kind of where we are right now and what we've seen change over the last couple of months and year, we started with cap rates that were more or less everything was in the three range towards a four cap, and that could be an A product, B product, C product. In today's market, we have seen them start to space out between them, and if we start with the A, we are seeing anywhere from the high four cap rate to a 525. That's the going rate for a lot of the Class A's. The Class B's, I would say they are between a 5.5 and a 6, with a sweet spot of 5.75. And the C's, they are a little bit more volatile because typically you're seeing some of them needing a little bit more capex up front. So those can vary, but I would say a 6 to a 7.5, depending on location and quality. So that's what we've seen. And again, all those assets, they used to be more or less the same, which is it should probably be this way where you're seeing a difference between the different asset classes. Going forward, I think we're going to see for the foreseeable future being around the same cap rates. And typically what I'm being asked is, we have seen a rate come in and then we are expecting another one. Should the cap rate starting to go down? Yes, eventually, but it's not going to go down the day after a rate cut. It will take some time for the rate caps to absorb that environment with lower rates, and quite frankly, also showing the stabilization of it, because the last rate cut we had was in September of this year, and since then it has steadily been creeping up, and we're in fact slightly higher than where we were right before the rate cut. So again, what I'm looking for is a continuation of several rate cuts that sets a trend, and that will start to make a compressed cap rate. But so
Yeah.
far, I think 25, we will be about the same cap rates we're seeing right now.
Okay. Love that information. So talking a little bit about what you just said there, you said we had the cut from the Fed, and then we've seen rates creeping up. Now, just to get a little bit more detailed here, we've got the 5, 7, and 10 year, which is I think what you're talking about creeping up. Is that what you're focusing on when you say that?
Correct.
Yeah. So 5, 7, and 10 year Fannie Mae, Freddie Mac debt is incredibly common debt in the multifamily space that a lot of us as operators use, and it's not directly tied to the Fed fund rate. Do you have any information that you could share on the correlation between the Fed's fund rate and the 5, 7, and 10 year? How because the 5, 7, and 10 year have been significantly lower than if you're going to go buy a home mortgage. You're at 7.5%, and the 5, 7, and 10 year have always been between 5 and we ran up a little bit end of 2023. It got a little bit higher there in the 6 range, but other than that, it's kind of hovered in that 5 to 5.75 range for most of this. What's the separation? Do you know anything about that, Jakob? You can share with us, and why?
Unfortunately, I'm not too smart for that. We have a lot of very smart people that looks into all those trends. For me, it's as much of taking a step back and maybe not looking at the graphs and not just listening to the economists, but seeing what we have on the table in front of us. One thing is when you're looking at these rates, they're typically, and that goes with the Treasury, it goes with SOFR too. They build in a lot of risk. So a lot of it is already, for good and bad, coming in the foreseeable future, kind of already baked in. The other part is what's really important for us is not just the rate. It is really the all-in interest rate, what we are paying. And there are two parts to that. There's the rate and there's the spread. We have experienced here in the past some of the lowest spreads in our time because people, they need to do loans, and so they're hungry for doing loans and they are lowering the spreads. And that's the other part of the equation. Now, when we're seeing the rates going down, the spreads are starting to widen. So what I would really look at is as much, where are we all in as an in borrower? Not so much just the rate, what it is today and potentially what it is tomorrow. No one really knows. But what we have seen so far, we have gone up above 6. We've gone to almost 6.5 all in rate. And then here a couple of weeks ago, we could lock down with some buy downs, whatnot, just sub 5. Reality is we're probably going to be in that span somewhere. Sometimes you get to lock a loan at the right day and get slightly better terms. Some days you're not so lucky, but to see that the rate suddenly should jump to a 7, 8, or 9, or it should go the other way and be a 2 or a 3, that's very hard to see.
Okay, yeah. So, with the market shift, has the profile of active buyers shifted, from who you saw buying in 2021, 2022, and compared to who's buying now? How would you describe the buying pool today versus then?
Sure. When you have tougher times, you are seeing different profiles, maybe not necessarily right now do better, but hanging on better. And then we are seeing groups that maybe have not set up as well on the asset management side and whatnot, where they're folding much quicker. And that's a little bit more on the private side. When we look at the different groups that are involved, and that's from the smallest kind of syndication groups, individuals, to private family offices, all the way up to the institutional money coming in. We are still seeing all the people coming in. The institutional money, they have been on the sideline here for a while, but we are starting to see them coming in. We just had a property, and this is about a mid $50 million property that transacted, and we had a very good outcome of offers on it. And when we go through and look at the different people offering, we did have anywhere from private individuals, their own money, syndication groups. We did also have some institutional people coming in as a sponsor, but also as equity for other groups. So I think everyone is active. Everyone is looking probably for too good of a deal, and that is also why we don't see as many transactions right now. But all the different groups are still active. The change we have seen, and that's typically when we have a shift in the market, is Texas in general. Dallas is a good story. That has not changed overnight. We are still seeing a tremendous amount of new jobs being created in the state and in Dallas and DFW in general. We are still seeing the economic growth coming here. So it is a place a lot of people want to be. So we have seen new people coming in that I would not have thought about when we take a deal to market, and had good conversations. Said, hey, we have eyed the market for years, months, and we want to buy something now. We think this is the opportunity to buy, and it's not just about the pricing and the cap rate where there is an opportunity. It is as much a bid sheet where there might not be 20 people ahead of me. I actually have a fighting chance to get a deal, the deal I wanted. So we have seen those people coming in and kind of plugging the holes for the people that is on the sidelines.
Got it. Good stuff there. In your groups, and you're talking to your owners and buyers and the sellers, what's your take on the percentage of distress you think we're still going to see come in 2025? Do you think we're past most of it, or do you think most of it's yet to come?
That's a good question. We talk to lenders, we talk to operators, we talk to sponsors about this matter, and we have seen some foreclosures. I think in general they have been more quiet than what we had expected. Quite frankly, we have seen groups coming in, taking over, and having an engagement with a lender before it even gets foreclosed. So when you're seeing it go, for foreclosure, there's already kind of a deal being made. And that is where I think we're not going to see the blood in the streets we would expect when something is happening. That doesn't necessarily mean that people are not getting hurt in their current positions, but there are enough people coming and gulping a lot of this real estate up very early before it really hits the market, and it looks like every other deal's got foreclosure signs on them. Pending on how 25 goes, and also pending how operations, especially in 25 goes, we have still seen some upticks in bad debt on properties that doesn't help when you have more debt to pay on a monthly basis. If we're just going to start to see that go away, I think that would help a lot of current owners. Same with occupancy. We were in the end of 22, beginning of 23, we were in the high 90s across the board in DFW. And today we're sitting closer to 92%. So it's not unhealthy, but it's not 96 anymore. Some of this has been caused by the amount of new units coming into the market. We're scheduled here for the next 12 months to put in about like 45,000. We have seen a lot of units come in lately, and we're still going to see a lot. After that, the construction pipeline will start to calm down. And quite frankly, if we look out 2 years from now, 3 years from now, it is almost at a standstill right now with new construction starts. So there is light in the end of the tunnel, but when you are still putting a lot of new product in, the competition is higher, and there is more of a supply demand issue. So that will determine some here in the future. But again, I don't foresee us seeing here right now, 1 year from now, that there is 25% REOs in the market. I just don't see that happening.
Yeah. Thank you for that. So when you guys are bringing deals out, you're seeing bad debt is increasing. I'm assuming that's going to be strain on the economy as, we're having less jobs and the report is less jobs. Is that what your take would be, is why is bad debt is rising? Or do you think it's purely operators between great operators and poor operators? And then are you seeing any strategies that the great operators are doing to keep their bad debt down versus the operators that are struggling more so?
Yeah, and that's really the essence of the business right now. There are some of these bigger things you really can't do much about, but you can work on your operations. I would say overall it's a mix between the concepts. We are seeing the occupancy go down, and we have deals now that are maybe down in the 70 and 80%. That is cost one thing, like when we're talking about the capital stack, and a lot of people came in with the idea of, hey, we're going to improve this asset, we're going to improve it so we can get anywhere from $100, $200, $300 more in rent per month. When you then suddenly have tenants that are proportionally not making the same money as you are asking, there is a fundamental issue. Now you have a business plan that you can alternate or you can continue to work out. And sometimes in this situation here, again, there are some unforeseeable costs with rate caps. And if you didn't have a rate cap, increased cost just to interest rate, and something's got to cover it. So if you started with a deal that traded around a 3 cap or 4 cap, and you need now a 5 cap or 6 cap just to survive, you've got to push. And we have seen those situations where people are potentially over pushed, but I think it's for the reasons that are very reasonable. You're trying to survive, and the deal broke on you trying. So it is really a hybrid between the different concepts right now, what's causing it.
Yeah. Yeah, definitely. And I think the point that you made and is worth reiterating is you've got this, large supply coming on that was started a few years ago, and it's coming to the market right now, and supply demand gets out of whack. You've got higher delinquency, you've got higher bad debt, you've got lower rent, and you've had expenses creep up, and you're in a position where rates ran, and it makes a really perfect storm for a lot of pain or blood in the market. And your
Correct.
point, the point you further mention is 2-3 years from now, it's almost at a standstill, if I remember you right, is as far as new product, which, then you're going to see likely supply demand get out of whack the other way. So if you're in a deal, or let's say you're in a limited partner in a deal, it seems to me like you're rooting your hardest for the management team and asset management team to navigate the storm to survive another 2-3 years as a potential exit then, huh?
Yeah, I think that would be ideal. Unfortunately, a lot of these programs, debt programs that are in place, will not really allow you that amount of time. A lot of them was built around like a 2-year loan, a 3-year loan, with the ability to extend for 2 or 3 years. And this now we're already in for many of them in year 3 and going on some of them year 4. It's easier said than done on some of these situations here. But you're absolutely right. When we do not have like the same amount of inventory, it trickles down. Now, having said that, again, if you're owning kind of vintage workforce housing built in the 60s, 70s, 80s, there is some overlap, but it's not a direct competitor for the same tenant that goes in and rents at a brand new constructed property in the Metroplex. But it is pushing people back and forth for sure.
Yeah, I'm glad you brought that up, Jacob. I mean, when we look at our portfolio, some of our workforce housing is the most stable we've ever seen, or it's just as stable as it always was, with really nice rental increases happening. Yeah, they're older product and you have more CapEx and you better have allocated that correctly. But some of our newer stuff that's in nicer locations is just are off on what we would hope we'd be able to hit for rent. And, for those deals, it's tighten up where we can in our expenses, be as good or better than the submarket, and hunker down. And hopefully you got the right debt in the right place to survive another 2 or 3 years. So
you're absolutely correct.
Yeah. Glad you mentioned that. So with financing, what are you seeing right now that most buyers are using, or what kind of financing strategies are you seeing on deals you're closing?
We have actually seen a mix lately. It switched back early in the year, and everyone wanted to do agency just because it's less volatile. And when you're seeing the rates jump up and down, you're trying to avoid the volatility. In today's market here, we are seeing it going almost 50% on each side, where we see bridge debt and an agency. Those are still the two main pieces. We are starting to see some CMBS again going into certain markets, especially secondary markets. But the other two, those are taking the majority of the deals. Now, there are concepts the pros and cons on both, because in comparison to the last almost decade, or I would say 6 to 8 years, we have high interest rates right now. And if you look at it and you're going for a 10-year commitment on an agency loan, and the market shifts in 2 years or 3 years, you're still sitting on that loan for the next 7 years. And you have a lot of yield maintenance or service at the point of dismount if you elect to sell in 3 years. So there's still a lot of people that are looking for the flexibility. The private lenders will give you that flexibility, obviously at a higher rate right now. So we are seeing two main roads of thought, if you will, where people are playing more the short game versus people playing the long game.
Yeah, it makes total sense. I appreciate that. You've been in the game for quite a while. You've been at Newmark since 2012, and you've been in commercial real estate since 2006. How would you say today's market cycle compares to past ones you've seen? Like back in 2008 and 9, I was a full-on professional snowboarder, knew nothing about multifamily, didn't have it on my mind one bit. And I've talked to a lot of folks who've been around during that time, and obviously this is that next real pullback since then is kind of the conclusion. How do you see it comparing to what happened, back in 2008 and 9?
That's again, really good question. I'm trying to figure that out every day, and trying to contrast and compare to what I saw at that time. There are two things. Real estate will have its rolling waves, and that is exactly what we saw earlier. It will happen. We have to cycle through it. It's more in respect to how that wave actually looks. And if you're in the mindset of looking back at history and say, okay, this is what I experienced. Let's take, for example, starting in 09, going through 10, 11, 12, where we had some major companies suddenly just disappear on us, and we thought it was a top of the market, best in class firm, and it comes to show that their books were not right. I don't think we're going to see that like that. And so we're not going to see the same ripple effect on the loans and owners in general. The other part is, and speaking specifically about Texas and DFW, back in that cycle, we were considered a secondary market in the United States. There were a lot of guys, investors, they would not look at Dallas, they would not look at Texas, they would be on the coasts. A lot of stuff has changed since then. Now we have a lot of international investors coming to Texas, to Dallas. Like the story, it's more on the map. So some of those parts will change the narrative for this cycle here versus the last. So if your game plan is to go in and just wait for exactly what happened last time, I think it's going to be hard to be successful. You got to look at it with new eyes. Use what you know from the past, but it's not going to be the same face this time around. And so far, it has shown that.
Yeah, for us, with what we're looking at is we've gotten comfortable with some locations and some asset types and some demographics and some value add strategies. And, moving forward, what can we do to go recreate some of the deals that have performed the best for us? Obviously no two deals are exactly the same, but there's a lot of similarities. And ideally you learn some lessons in the pullback that we're in right now. And if you want
Yeah.
principles, call them principles, and you take that knowledge, right, and you work with the smartest people you can around you that have been through past real estate cycles, and you proceed with caution. And I think the folks that aren't going to buy in the next year to 2 years or even 3 years are really going to miss an opportunity that will look back. And I think it's going to be the time where, we all wish we'd have bought a lot more or could have bought a lot more. So
Absolutely right.
yeah. Yeah. So, if you were switching places, from a full-time to a full-time real estate investor, what kind of deals would you be going after today, Jakob?
Well, that's a good question. We look at these deals every day, and like sometimes you look at them almost too much. So you got to take that step back. But one of the things I think, especially with the Metroplex here, DFW specifically, we're seeing is it's growing into a full city. It's built out 360 degrees. Where just going back to the last cycle, we still had a lot of unused infill land that is more or less gone now, and we're moving out towards, quite frankly, Oklahoma to build out the Metroplex. So one of the things I like is not a new concept to real estate, is location. And I think if we could find a place where there's a scarcity of land to build on, there are some fundamentals around you that doesn't just necessarily mean that you have to do the work, but you can get help from your neighbors, and that could be retail, office, single family, infrastructure. Those are some of the things I'm looking for. Schools, I think, it's become an increasingly important part of site selections. So when I invest in deals and I'm looking at deals, I'm looking at those parts. The other part is there are vintage deals in Dallas. Some of the new parts of DFW, and here I'm talking about the McKinneys and the Friscos and the growth corridors up north of town, there are not any apartments built. So when you are delivering rental products in those markets, it is what it is with the pricing, because most of it is new or newer, and you have some construction costs you got to cover. So the rent will be at a certain level for that to make sense, meaning that you're still building a ton of restaurants and schools and whatnot, and it's not necessarily a match for all tenants there. So now we're seeing a vacuum coming behind it of rental space needed. And that's where I think some of the northern tiers of Dallas, pushing up to the Richardsons and the Carrolltons of the Metroplex, I think they benefit from it now, and they will continue to benefit of this expansion of the overall Metroplex. Because reality is, with current construction costs, land costs, and debt for new construction deals, you cannot get close to offering any rents close to a vintage product. So you have deals that, are to some degree insulated from the supply demand when it comes to the growth here
Yeah.
and the unit delivery.
Yeah, understood. That's some good information, folks. If you have time, listen to this again and jot down some notes for your future investment deals you're looking at investing in. Jakob, anything that I didn't bring up that you think is important for our listeners to hear about the state of the market right now and transacting deals?
Yeah, I think it's not a direct point regarding real estate per se, but one thing I've learned, and this is from being in the business for a long time, it never feels super easy to deploy money in the best market because none of us really knows when the bottom is there is hit. It's easy to look back and say, "Oh, I wish I've done this 6 months, a year ago." So one thing I would do, I would use the fundamentals, some of the stuff we talked about locations and the future supply demand of certain locations and potential rent growth. But I'm a big believer of deploying when people are not deploying. When a lot of these bigger institutions are going to come back in full swing, everyone flocks to it. And now it's really hard to get a deal, can't get in, and your returns are not going to be the same. And your risk profile on the back end is much different than when you start at this level here.
Yeah. I think that's the point that really needs to be heard. You know, I look at a lot of our investors, and granted, they had a bunch of deals turning, right? And you're selling deals at peak pricing in 21 and you're doubling your money in 12 months. And you've got this capital gains bill that's coming at you. So you're looking to stuff it into the next asset. But you look at the time, and the most risky or the most dangerous time to be buying would have been late 21, early 22, when it seemed like no one could do anything wrong. And now where we are in the market, there's a lot of fear. And the line that keeps coming up in my mind, Warren Buffett, when others are fearful, be greedy. And when others are greedy, be fearful. And I think that we're coming into that time if we're not there already.
Absolutely.
Yeah. Well, gosh, Jakob, I really appreciate you coming on our show today and the insights you've shared. It's great to get, an inside look into how everything's unfolding, and we appreciate you taking the time to join us. If folks want to reach out at all, is there a contact you'd like to leave them, or what's the best way for them to get a hold of you?
Yes, they can email me. My email is jacob.andersen@nmrk.com, and it's JAKOB.ANDERSEN at nmrk.com.
Great. Well, that's it for today's episode of Keeping It Real Estate. Thank you again, Jakob, and the fantastic insight. And everybody be sure to tune in next time. And don't forget to subscribe for more conversations just like this, and we'll see you soon.
Thank you so much.